Good evening, ladies and gentlemen. This is Barry Norman on behalf of ITA for Option Valley, and welcome to our class, Trading the Economics Calendar. Tonight is an exciting class that is broken into two categories. First, we're going to talk about learning how to read and understand what the economics calendar is, and from there, we're going to learn how to build a strategy to trade economic events directly from the calendar. Now, the economics calendar is a tool, and that's all it is. It's a tool. It's not part of any trading signals. It doesn't give you signals. It gathers data and feeds you back information. That is it. It does not analyze the data in any way. It's not a reflection on the economy. It's not a tool to tell you to trade something. It's not. It's just a place that gathers together information in a very quick, easy manner so that you can make intelligent, quick trades. It's a way of keeping all the economics data that goes on around the world in one concise, easy place to see, because something that happens in China has an effect on the metals markets, has an effect on the commodity currencies, has an effect on the euro, and has an effect on the global markets. So you need to know that this event is due to happen in China, and so you can be prepared for it to have some type of an impact on what you're trading. And you couldn't possibly gather all this data together yourself. So especially with computers, it gathers it all and feeds us the information back. And now that we have computers and RSS feeds, we get the data almost as fast as hedge fund managers, pension fund managers, brokers get the information. When I first started trading 40 years ago, you couldn't get this. We didn't have computers, and things came out in ticker tape. So unless you had a big brokerage and you had a ticker tape coming in there, you couldn't get this data. So it was very hard to compete in the retail side of the business because you couldn't get the information to make smart trades. So we were all technical analysts because we could get the information for price. We couldn't get reports and data and speeches. Okay, we couldn't get comments that were happening. So all of this is very important. Now, like I said, the calendar does not put together, does not make a statement on the economy or the value of a currency. It simply reports data. Now, the first thing I need to do is qualify what I said to you about getting the information as fast as pension fund managers and hedge fund managers. In essence, you do. And for binary options, the gap in time is not important. But to be fair, a lot of these reports are released by private agencies. Okay, they're collected by private agencies. They're in the business of making money with their reports. Okay. Now, there's nothing underhanded. There's nothing conniving. These agencies, or like Thomson Reuters, Marquette, all publish on their website, okay, and tell you exactly the time delay between the time the data is released to what they call their subscribers and what is released to the public. The biggest variance I've ever seen is 2 minutes. Okay. And like I said, this is fully disclosed way ahead of time. Now, these subscribers are paying thousands of dollars a month or a year to get this data and are subscribing to that company's feeds and supporting that company, so they should be entitled to get it a little bit faster than we're getting it free. And for us in binary options, like I said, it doesn't matter because we want to see the big professional traders' reaction to the data anyway to make our final determination if we were going to make a trade, because we need their movement to verify what we have decided independently on our own. So what we're looking at right now is today's economics calendar, and I just took a screenshot of it for us. We'll go over to look at them live. Now, economics calendars are available free of charge all over the internet. We have one on the Option Valley site, and we also have them on the Investors Trading Academy website. So you have them in two places, easy to get to, free of charge to you. You can also get them from FX Empire, Investing.com, Forex Pros, Market Watch. They're available everywhere. And one calendar is not necessarily better than the other. Okay. What varies between the different types of calendars is, number one, the graphic designer. How well he's put it together and how well he's made it for you to read. Okay. Because the data comes from feeds. It's the same data everybody's getting. Also that you have to know is that the economic events around the world are uniformly broken into 3 trading levels: top tier, tier 1, tier 2, and tier 3. This is not a subjective decision done individually by websites or providers. It is a global accepted rating system. So you're not going to find any more deep detail on somebody else's calendar or something that's give you an edge. Now, some companies who offer calendars have more information available to you. Give you more data, more easy ways to get descriptions and stuff. But that's really like how much news you want to read, how much research you want to do. And we're going to look at that in a second anyway. Now, what we're looking at, so first let's talk about how to read the calendar. And almost everyone is set up exactly the same. I can't say all because I haven't seen all of them, but I don't know of any that have much of a variable to them. The first column that you're going to see is the date and the time. Okay. Some have the date right above, some put it in the middle, some put the day of the week right there. Okay, but it's always the day and time in the first category. Now, there's an important thing about these, and these are called filters. And you can set the filter. Let me take you over to a live calendar to show you all this. Hold on, let me bring a live calendar up on your screen. Hold on. Okay, so we're looking at a live calendar from Investors Trading Academy. The first thing you need to do as a trader is find where the particular calendar you're looking at gives you the time settings. All the calendars out there allow you to set the calendar in your time zone. That should be the first and only thing you do, because you can make serious miscalculations and trading mistakes by having the wrong time zone set for these events. And it's a lot easier just to keep track in your own time zone when an event is due to happen. So like today, if you're like in London right now, it's 16:53 in the evening, and we know that it's 1700. We're going to get FOMC member Rosenberg, that's Mr. Rosenberg, who's president of one of the central banks in the U.S., is going to make a speech. We don't have to figure out how far from that is from now. We don't have to figure out if we missed it. We'll automatically know what it is in our local time zone. Okay? And there's so many events you can make. You don't need to sit there and calculate what they are. So the first thing you want to do is set it to your local time. Okay. Now, once you've done that, there's another one, and almost all the calendars offer filtration or filtering systems. Okay. Now, the one on the ITA site and the Option Rally site offer extensive filters, and by just clicking on, by just clicking on the filter button here, we'll open up all the various filters. Okay. Now, I've already filtered down the calendar we're looking at, because the thing is, we don't need to look at countries that have assets that are not available on our platform or that we're not going to be trading. Now, before you say not trading, you don't want to cut off U.S. data because you're only trading the euro. You don't want to cut off Chinese data, because you're not looking at anything out of Japan. You should always keep all the major currencies/countries open. So you can see I have China, Eurozone, I have Australia, I have United Kingdom, okay, France, Italy, the U.S., Canada, Germany, Japan. You don't need to keep open all of the Eurozone countries, because most of the smaller Eurozone countries, their economic data is not large enough to move the value of the euro. Germany is the largest economy in the Eurozone, so we keep Germany open. And Italy, France, and Spain we keep open because they can have some effect on the value of the currency. Okay. We don't need to keep open Saudi Arabia. We don't need to keep open South Korea. We don't care much about Cyprus or Belgium unless you happen to be trading something from directly there, and you can always turn them off and on. New Zealand, we're always interested in. Spain, we want to keep. Once we keep these, we can change them all we want, or we can just leave them set where they are. Okay. From there, we want to select the types of data we want to see. Okay. Now, we should always leave these all open except for bonds. And unless you're trading in bonds, which you can't do on the Option Rally platform anyway, you can take bonds off. From there, we go to the level data levels, where you see our particular site, because we get a lot of our stuff, a joint venture with investing.com, is we use the same symbols they do. One bullhead is for Tier 1 data. 2 bullheads is for Tier 2. 3 bullheads is for Level 3 or Tier 3 data. The most important data, which is Tier 3 data, which is enough to move the markets, okay, is what's important for trading. But you still need to see Level 2 data. Right now, I'm going to click on 1, 2, and 3. Now, we've already isolated down the countries, the types of events, and when there's so much data that's being released, if we leave Level 1 open, which are small data, pieces of data, or they're what we call leading indicators, they give you some information that will be part of a larger report. Okay, it gets to be so long that it gets so complicated that we'll get lost in the charts. So the easiest way is to filter off your Level 1 data. So now, personally, what I do in the morning before I start looking at everything, I always open my economics account to see what's going on for the day. I'll open it, take a look at Level 1 data just to be aware of what's to be expected. And I'll see that some country, some country or some asset I'm watching will have a lot of data, so it's in my mind. Otherwise, I take it off the calendar, and once you take the Level 1 data off, you're up with something that you can work with. So as you can see, in the first column now we have the time. Okay. Now I've got everything set to GMT time right now. After that we have the currency. Okay. Now it used to be we would just see currency symbols here, but as the euro continues to grow, and it's important to see what country is releasing the data, even though we know it affects only the euro, we have now the flags and the name of the currency. Now, these are the currencies that will be primarily affected by the release. But remember, data releases don't just affect currencies. A very bad release in China or a very good release might have an effect on metals. When Chinese data is very poor, copper takes a big plunge because there's less implied demand on copper. Okay. Oil has an effect on everything around the globe. Now, you should be aware of how they'll also affect. Say, for instance, today we had you can see we had the Halifax House Price Index. Okay. Now, the numbers came out pretty good. They were better than expected. So don't you think at that moment it also had an effect on the stock of the publicly traded builders, or like B&Q shares, which is the largest renovation center in the UK. It doesn't send them through the roof, but it does have an effect on them, because the stronger the housing market is, the better their sales should be. So we should be aware of what else could be possibly affected by this. Then from there we go to what we talked about, the bullheads. This is impact, importance, or tier, or volatility. Any way you want to describe it. I was taught when I learned how to trade that it's Tier 1, Tier 2, and Tier 3 data. Tier 3 data is the most important data and will move the markets. Tier 2 data can have an effect on the markets, but won't always. Okay. And you'll learn after a while which one of these are important. Basically, the bigger the country is, okay, the more important it is. So we see we had building approvals out of Australia this morning. It was a very good report. It was a level 2 report. But it did have an effect this morning on helping push up the Australian dollar. This afternoon, we had German factory orders that was pretty bad, and it did push down the euro as soon as it came out. And I'll show you that on the charts in a minute when we start to look at how to trade these. First, we're just looking at how to read these. Okay, so let me just get my markings off of here for you. Okay. So after we have the time, the currency, and the importance or volatility of the event, we go to the actual name of the event. Now, when you first start trading, okay, all of these names are going to be confusing, and there's lots of data released. Almost every country releases the same data. They just call it different. Like we see today, and again in the UK, we see Halifax House Price Index. Well, in the US, we happen to release the Case-Shiller House Price Index. Basically the same thing. Okay? They are the value or the price of the movement of the houses. Okay? But you don't have to spend a great deal of time figuring it out because there's a very easy way to do that. Whenever you see these events, there's going to be a way to get an explanation. Some will have a little detail box. Some will have a hyperlink. Some will have ours. You just click on it. So if you click on building approvals, look at that. It opens up a screen, and we can click under overview. It tells us building approvals, also known as building permits, measures the change in the number of new building approvals issued by the government. Building permits are a key indicator of demand in the housing market. A higher than expected read should be taken as bullish for the Australian dollar, while lower the opposite. Okay. We also have 3 other pieces of information here, or 3 other sections. Okay. We're going to use these 2 other sections. They're very important. When we see charts, when we click that open, it's going to show us a historical level of how this report has come out. We can see over the last year, the last 2 years, and we need to know this data. Okay, and it's at our fingertips. You just need to know where to get it. Okay, the next we're going to see is on history. We're going to see the last 1, 2, 3, 4, 5, 6 reports, and we see how that report came out each time over the last 6 months. And we will need that data. And once we get to learn how to start building a strategy from this, I'll show you how we get this, read it, and why we need it. The last thing that's important here is up where it says release URL. And again, all the sites offer the same stuff. The release URL is the actual official releasing agency. And if you actually want to read and see the entire detailed report, just click there and it will take you directly to that report from that agency on their website so you can read it in great detail. But you will be surprised when you start reading these, because what you see across the screen is usually the headline, the main event, or the accumulation report of the whole thing. It is broken down into section on top of subsection on top of subsection. It goes on and on and on and on and on. I mean, if we look at just the Australian building permits, it'll be broken down into city, town, region, farm area, non-farm area, commercial, non-commercial, and it just goes on and on, because depending on where you are in the markets or where you're using this data for, you may need parts of this report. So the reports are rather extensive. Okay. But the headline event, the main number, which is the only thing we're concerned with, is what comes out across the screen here. Okay, now, we can close that by just clicking back on the level. Now, this is easy stuff. It's not complicated. When we move over to the right side, we're going to start getting into data that we need to understand. The first thing we get is the column on the right that says previous. Now, I'm going to take you over to tomorrow's report, because seeing reports after and before are a little bit different. So I'm going to click on tomorrow. It's going to pop up on your screen. And this is events that haven't taken place yet. So what you see in the right-hand column, it says previous. we can take the first event. We have a major event coming out tomorrow morning for the Australian dollar. We see it 0030 in our time. It's retail sales month over month for the month of November. It is a top-tier data report. Okay. The previous, that is the number that was released when this report was released the last time. So if it's a monthly report, it's what the data was last month. If it's a weekly report, it's what the data was last week. Okay, that's it. Okay. From there, we come to a very important number, and that's called the forecast. The forecast is a number that comes from surveys done by these same agencies, but the surveys are not surveys that are done on the telephone or in the shopping mall. These are questionnaires that are sent month after month to the same people, to the same professionals within these particular industries. So the answers they come back to, and it's not subjective data. It's not objective data. It's subjective. It's asking, numerical values. If it's a purchasing manager's index report, they're asking, did you see the price of your goods that you were buying go up? If so, what percent? And that purchasing manager is looking at his reports to see that his raw materials went up 1% last month. Okay. So it is good information. It is so good and so dependable that the markets, the forecasts come out about a week before the data release, and the markets depend on this forecast. Okay. Now, once we go from the forecast, we go to the actual, and the actual is released live to us through RSS feeds and internet feeds directly to the website. Now, each website, again, is a little bit different, but it all does the same thing in the same way, shape, and form. In our website, about a minute before the data release, you will see a hourglass clock come up here. You'll also see the next report go down to a countdown. When it's at 15, 14, whenever it's the next report, it will drop down to how many minutes before that report's released. Okay, at 1 minute out, you will see the countdown clock come here, and it'll start spinning around until the feed releases that data, and it will pop up there. Okay, so this is how the calendar works. Now, we also have ways that you can look at the data forward. You can look at expected data moving forward by just picking days, weeks, and months on the calendar here. So you want to see how this report was last month or more detail on it. You can go through the calendar, pick a day, and you see what reports came out. So we want to see what came out on September the 9th last year. We can just click here. If we want to see tomorrow's data, we just click on tomorrow. Yesterday's data, we just click on yesterday. And if we want to see the whole week, we can just click on this week. Or we can use the filters here and filter down all kinds of periods we want. So right now we're looking at tomorrow's data. Now, before we go on to what happens when this release comes out, I'm going to take you back to PowerPoint where I'm going to tell you a little bit of a story. Some people say the story gets boring, but it's a very good analogy that's important that you understand. Because now we're going to start moving from getting the data to interpreting the data. So let me bring up the PowerPoint here, and I'm going to tell you a story about your kids and their report cards. Okay, now you have a kid. You're sitting down at Sunday dinner, and the report cards are due on Wednesday. So you have a data event. You have a major data event coming on Wednesday. Now, what do you know? You have the previous. Your son brought you home 5 C's and 3 C pluses last semester. That's previous. It's in stone. It happened. Now, you say to your kid, how did you do, or how do you think you did this semester? Kid says, well, it was a tough semester, and my exams were all right. I didn't get in any trouble. The teachers weren't complaining about it. I think I'm only getting all C's. Okay. Well, this is the forecast. Now, of course, at Sunday dinner, you're going to talk to me and say, if you want to get into college, you got to do a little bit better than that, and why aren't you studying harder? You're going to do all your things, but you're going to, by the end of supper, by the time you're cleaning up the dishes, you've now adjusted to what he has told you. Okay. Now, again, neither side of these, the previous and the forecast, is doing any type of analytics. You're not saying, and there's no interpretation, well, my kid's not so smart, and he's got a couple of rotted brain cells, and he was dropped on the head as a baby, and he was short air, so this is pretty good for him, and it's all right, but you're not saying that. You're not making any analytics about it. You're just saying to him, you got to study harder if you want to get into college. And you're slightly disappointed because he's not doing as well as you would have hoped for, and he's not doing as well as he did previously. Now, also you haven't talked about, is this better than the rest of his classmates? C's in his school, maybe he's in a tough school, and teachers expect a lot more, so maybe all the students are getting C's. None of this is part of the reports. Okay, there's no analytic data here based on the whole economy or the whole global thing. It's just a number. And this is important to keep in mind. Now, your kid comes home from school on Wednesday. He hands you his report card and heads up to his bedroom to get ready to go play soccer. You open up his report card and it is all B's. You are thrilled. You're ecstatic. You are having a very positive reaction. When he comes downstairs, you tell him you're going to take him to the sports store and buy him whatever he wants. You're going to be all excited. You're going to be smiling ear to ear. Why? 2 reasons. Number 1, he did better than last time, and he did better than your expectations. Now, if he would have told you on Sunday he was getting all B's, there would have been very little reaction. You still would have smiled because it met your expectations, but you wouldn't have been ecstatic. Well, this is exactly what happens when we are in the markets trading. Traders are just like human beings, okay? And they have actions and reactions. So let's go look at today's calendar because those events have already taken place. So when the data, okay, we already had the previous, and we already had the forecast. Now, whatever the forecast is, the markets tend to factor that in. The price of those assets and everything else have adjusted down. I mean, if we were expecting a very bad non-farm jobs payroll report or a very bad retail sales report, it's already factored into the price of the currencies and commodities. Okay. For trading purposes, we are only concerned with now the actual and only when it happens. So what's going to happen is when that hourglass stops turning, a number is going to pop up on your screen. Like here, we're going to look at Australia building approvals, and it came in at 7.5%. Now, a data release can take a very long period of time, especially if it's a long, complicated, involved report, because each one of these data in pieces or subsections, say, are released. Once they finish the overall release, okay, they go back to what's called revisions. And revisions are very, very important because this is all data that's being constantly collected and collected up to the moment. That sometimes there is additional data that comes in after the report is released. If that happens, it is then revised at the end of the release of this month's data to tell you that last month's data was also revised either up or down. Now, you see this in 2 ways. If you see a yellow dot on the screen, on the report, some have a star, some have a little check mark, it tells you that the previous was revised. Now, when you get data released, green numbers mean the release was positive. Doesn't mean it was higher or lower, because some numbers need to go up, some numbers need to come down to be better. It tells you that it was a positive release, better than expected. If it's in red, it was worse than expected. Now, when we do the revisions, if you put your little mouse on the dot, the check mark, or whatever else, it's going to tell you what it was revised from. So when we're looking at the top line here, the Australian dollar, the Australian building approvals, we see it was revised from 11.4 to 11.5. Okay, that's a small revision, but it's also a small number. So that is good. And you're going to have to remember about this, because when we go talk about the strategy for trading, this comes into play. We also see at this time that the data was released at 7.5%. Against a forecast of a drop of 3.5%. That was a huge, significant upward movement against what we were expecting to be a downward revision. So we got a downward forecast. So we got a very good report. We had a upward revision of the previous. Now, the thing you have to keep in mind, okay, is data affects the markets now, and it's immediate effects. But then it also has an effect slowly over the markets, over sometimes the day or the week, because the markets are going to react to this building approvals report being extremely good, and they're going to react to the previous revision, and they're going to make an initial reaction. After all that's over, then they're going to go back, because what they're more concerned with is not just today's release. Because data and events can have all types of misleading effects. Because, say, the month started on a Sunday. Okay, so the first of the month started on, say, a Saturday. So the first 2 days of the month weren't calculated. It was a short month instead of a long month. It had extra holidays in it. It had extremely bad weather. Okay. So overall, economists and traders will then go back and start evaluating the data in quarters, at least, and start saying, okay, how did this make the quarter turn out? Now, to give you an example, several months ago, we had, actually it was last year, beginning of last year, we had 2 very strong months of U.S. non-farms payroll reports with 2 high reporting months, way above expectation. Well, the third month was a horrible month. I think we were expecting 200,000 jobs, and we got 135,000. So the immediate result in the markets was the dollar plummeted. But the fact is, when you looked at that report, there was a big revision up to the prior 2 months, which were already very good months. And when you took the 3 months together, the quarter was a phenomenal quarter. And it happened to be, I believe it happened over a holiday weekend. And so the numbers that were revised up from the last month upward, if you added those into the bad part of this month, they actually made this month at forecast. So you have to, all of this is taking effect, but the immediate reaction, and you do get an immediate reaction, is based on the headline numbers right away, and then you will see that the asset will react and then correct itself when the traders have time to evaluate. With binary options, we're only concerned with the action. Okay, so this is how the data comes out. This is how you read the economics calendar. Now we have to learn how to make this worthwhile trading. Okay. Now, the thing about the economics calendar is you can plan the events way ahead of time. You can sit down on a Friday, Saturday, or Sunday when you have time free and pull up the calendar like we can do right now and do this week, and let's go to next week. I don't know if all of the we can pull up all of next week's events. Let's filter it down, because the only events that are worth trading are level 3 events. We need to be aware of them all. But if you want to sit and build or build a trading strategy for the week on data events so you can sit down on the weekend, and here we have all the top tier data events coming next week. Now next week's the middle of the month week. If you were looking at this week, there would have been tons of them. So next week we have 2, 3, 4, 5, 6, 7, 8, 9 of them. Okay? That's enough to keep you fairly busy and get a lot of trading in. Okay. Now tomorrow we have a very, very important data day. Now, because you have these, we have the previous, and we already have the forecasts for most of these. Some of them will get filled in tomorrow, and by the weekend, you'll have all the forecasts for all the data for the next week. So you can sit down over the weekend and start building your trading strategy to trade from the economics calendar during this week. And the nice thing is, once you do this, and I'm going to show you in a second how to start building what we call market neutral, market positive, market negative. You build these categories, these territories, and as that report comes out, all you have to do is, even if you're at work, you sneak away from your desk, you go get a cup of coffee, you have an app on your phone that's giving you the data releases, you've already got your trading scenario, your trading strategy built. You just fill in the numbers where you expect, where they come out, see where it tells you in your market neutral, market positive, market negative strategy. You go make the trade, go back to your desk, and by the time you get back from your desk, finish a cup of coffee, you got $100, $200, $1,000 trading. You're making extra money. So what we have to learn now is how to analyze these events and how to build what we call market neutral, market positive, and market negative. To do this, we're going to use tomorrow's events. Because tomorrow we have a very, very important day. Okay, we have the non-farms payroll report coming tomorrow. Okay, that is the granddaddy of them all. That is the most important, most watched report in all the markets. Followed after that by Federal Reserve meetings, which are bank meetings, and the Eurozone, European Central Bank meetings. But those are the three biggest events every month. Okay. Now, the non-farms payroll report consists of a lot of data. A lot. It's an evaluation of everything that happened in the jobs market in the U.S. So it actually takes quite some time to be released. So let's pull it up. I actually have a chart pulled up with them on there, but you can see them here at 13:30 tomorrow. So hold on, let's go back to my PowerPoint where I have this pulled up and ready for us, and let's start talking about what we would do. Okay, just let me get Okay, so what we want to do is we need to start building what we call market neutral, market negative, and market positive. Okay, market neutral is the area around this data event that won't have a tradable effect on the markets. This is a zone. The next we need to look at is what's market negative. Market negative is a zone where it's a bad enough report that that asset will fall significantly enough that we can make a trade, a safe trade. Market positive is the reverse, where that data is strong enough that we can make a positive trade or a trade in favor of that currency. So let me show you some examples of what happened today. Oh, but we went the wrong direction. Sorry about that. I got to get to the right page on the chart. Okay. Now, today we had two significant reports. We had central banks. You can't trade from the economics calendar, but we had a big event today, which was the Bank of England report, but they didn't do anything. They haven't done anything in months. But we had German factory orders today. We're going to take a look at the two major euro events that happened today, because the euro has been, we're waiting for the ECB to do some stimulus, and the euro has been down at a very, very low point. And so I took German factory orders. Okay. Now, you can only trade these events within 15 minutes of the event taking place, because there's no guarantee how long it's going to move in a particular direction, how long before some other news or other things happen, how long another event, like in this case, if you were wanting to trade the euro against the pound at 8 o'clock, right an hour later than this, you had UK data came out that was positive, that would have offset the other things. So you've got to trade the trading scenarios. You need to make your trade within 5 minutes of the data event and be out of the markets in less than a half hour from the time of the event. So if you've been on the Option Rally website, you've seen under short-term trades, we've now added 5-minute trades, 300 seconds. That is a perfect time frame for trading the economics calendar, because that way you can trade this event. Because you want to watch. First you want to do is, you've done your analysis, you want to make sure that the traders, the big professional traders, are trading in the same direction your trading matrix told you to do, and then you jump in there and you can take that 5-minute trade in that direction, because that asset's not going to reverse itself in the next 5 minutes. So if we look at German factory orders, which came out at 0700 this morning, and then we're going to take a look at German retail sale, Eurozone retail sales, which came out at 1000 this morning. Okay, we're going to quickly look at these because we're starting to run out of time. We can see that German factory orders was expected in at minus 0.7%, but it came in really badly at minus 2.4%. Okay. So what did that tell you? You would have expected to see the euro decline. Now, it's a second-level report, so it won't have a major reaction from the euro, but it will be enough to push the euro down. Okay. After that, we had retail sales, and retail sales were expected at 0.1%. But we had a very cheery Christmas, and I guess all that Black Friday shopping pushed November retail sales up to a 0.6%. That was a huge increase, plus we had a revision upward for the prior month, so that would have pushed it into positive territory. So I've already pulled it up and got it ready for you. So let's take a look at the euro chart for today. Let me get to the chart here. Let me get my markings off of here. And you can see what happened was, this is the chart for the euro today. I put the red line in here when release of the German factory orders came out, and that was a very negative report. So what do we see? We see the euro tumbling down over the next half hour. Okay, it bounced back up and then continued back down afterwards. We wouldn't want to be here, but if we would have entered this trade anywhere, if 5 minutes after the report came out, we would have been out of the markets before it even bounced up, but it never came back up to where you would have entered the market anyway. Okay. Then we had, after that, at 10 o'clock, we had Eurozone retail sales, which were good, but it's a level 2 report, and we see that it pushed the euro up. And the euro stayed up for about an hour, then fell straight down, then went back up, and it's almost right back where it started at before, at that point. But we could have entered the market either one of these and gotten a very safe trading, because the euro did go up and didn't come back down for an hour. So we would have been fine here. German retail sales in euro came tumbling, and this is what happens. Now, the thing about it is tier 2 events don't have a significant response in the marketplace, but they can have an important marketplace. If you trade only level 3 events, okay, they have a significant response to the markets. So what we have to do is we're going to take a look at, hold on one second, let me get rid of my lines here. We're going to go take a look at tomorrow's events, and we're going to real quickly look at what we can expect from the non-farms payroll report, because it's the big daddy of it all. Now, just so you know that there are 4 pieces of information that are released with the non-farms payroll report. There's a lot of information. 5 headline reports. Okay, you can see these 5 on the chart right here, on the calendar right here. The first is hourly earnings, but that's only a level 2. The second is the non-farms payroll report. That's the number of new jobs created in the U.S. That's very, very, very important report, and that's a level 3. That is the headline report of this thing. So we're going to start from this point. We have the participation rate. That is a very low-end report, but we have to be aware of it. Like I said, this is all part of this whole report. This is all subsections. Okay. Then we go to private non-farm payroll reports. That's a level 2, but it does have an effect on how the asset will move and the overall report. And then we have the last is the unemployment rate, okay, which is a level 3. So in this case, what we have to do is we have to start out here with the overall non-farm payroll report. That's the big daddy of them all. We see previously we had 321,000, but that was a very, very high climb, and that was hiring into the month of November when we were hiring everybody for Christmas sales. Okay, the U.S. needs to create about 220,000 jobs per month, okay, to offset jobs that are being lost. Okay. We've had several good months. So unless this report tanks, we're going to have a very good quarter. Okay. Everything indicates that we should get a report at this level or higher. Okay. Now, what we need to do is, okay, we need to say, and a lot of this is subjective, we need to start building what we call market neutral, market negative, and market positive. So market neutral, first we're going to start out with the expectation is for 240,000 jobs. Okay. Now, we don't have time tonight to go into this. We do have a second class on trade the economics calendar. And I'm skipped a little bit of this because I would like to get through this, and so you get it all tonight. But remember when I opened up those windows and showed you those other reports when you look at the event? Those are what you would normally use to go see how the event has printed over the last year, and then how it's printed over the last 6 months, and what the variances of this report, what the average report is, because some reports are very small numbers, and then other reports. Do you realize in the U.S. new home sales or existing home sales runs in the millions of homes per month? So you don't know that, so you have to be aware of how big of a range it is. So there's some things that only have tiny, tiny little ranges. Some things have very big ranges. So you have to be aware of that. So after a while, you'll understand with the non-farm payroll report. If we see a report, and I'm going to tell you right now, the range for this report tomorrow will be 20,000 jobs. Okay. This means that market neutral will extend from 230 to 250. That's 10,000 jobs, or a total of 20,000 range on either side of the 240 projection. Okay. If the report comes in this range, there will be no tradable. This is not saying that the dollar or euro won't go up or down. What I'm saying is this won't have a tradable range that you could be sure of that you could just go trade. Okay. Now somebody asks, is it best to trade the U.S. dollar index itself or use it in a pair? Depends if the index is available to be traded. We don't have it open very often on the platform. You usually have to trade against a pair. The U.S. dollar is the only one that has an independent index. You could trade the U.S. dollar alone. Now, we're going to take the same variance of 20,000 jobs and break it in half again in each side, and what we have is from 230 to 220 is what we call market negative. That means it's going to push the dollar down. It's going to be negative for the dollar. That means the euro will climb against the dollar in this case. So if you're trading the straight dollar index, it will come down. Okay, with me? We also have the 250 range, which is now 250 to 260, which is the same 10,000 variable, that is market positive. Okay, market positive means that the U.S. dollar will gain momentum, and if you're trading the index, it will go up. If you're trading against the euro-U.S. dollar will fall. Okay. Now, if it comes out in the 250 to 260 range, and you're trading the euro against the dollar, you would then trade the euro to go down. You would take a 5-minute trade or the next expiry in a down. If you're trading, if it comes in market negative, you would do the exact opposite. But you need to, this is just the beginnings of building your matrix. Okay, so you're not going to trade just on this because there's a whole bunch more to this report. And this is why we have what we call market negative plus territory and market negative negative territory. We have market positive territory, and because there's only one part of the report that you can actually build numerical values to. Each of the others, you're adding on pluses and negatives. Okay. So let's go back and look at what that report is for tomorrow. And, wrong direction. So what we're going to do is we've already taken into account the primary number. That's right here. Okay. We now have to start looking at the other second level reports. The first level, and it's the last piece of data that's released, is the unemployment rate. So we're expecting it to drop to 5.7%. It was at 5.8. Okay, what's going to happen is if it comes in right where it is expected, okay, it doesn't have an effect. If it comes in lower than expected, that means we drop down to 5.6%, which is a possibility. That is a plus. If we go up to 5.8%, it's a minus. And what we do then is once we have the headline report, and hold on a second, let me get back to that page here. Okay, so let's say hypothetically, because I got to get all this off my screen, if this report were to come out tomorrow and the report would have been, okay, say the report came in at market negative. It came in at 250. I'm sorry, at 220. So we're in market negative territory. We're then going to start, because that's the first thing. We can't jump from market negative to market positive. That main report's going to be somewhere. Then we're going to start calculating. So if the unemployment rate, which is really very important, comes in better, what we do is we put a notch on the positive side. If it comes in average, we don't do anything. If it comes in lower, we put a notch in the neutral side. Okay. By the time we get the rest of this data, we've made little notches in the market neutral, market positive side. So if this report came in at exactly 220, but we had an upward revision to last month, so that went into the market positive side. We also had an unemployment rate drop, and that went to market positive side. What happened was it pulled this whole market negative report back into market neutral. If you had 2 negatives and 2 positives, you ended up at the original market negative, but you have to take them into account. The unemployment rate and prior revisions have the most value. After that, the secondary have little value. So you can only talk to them. I talk to them about bumps. Some are big bumps and some are little bumps. Okay. And once you've moved into market negative territory, it also means you can move deeper into market negative territory, because if this report came in and we were expecting 230 and the report only came in at say 185, we're deep into market negative territory. So unless they had a huge revision upward and 3 other things in positive, you're deep in market negative. Okay. And you will see this, and it doesn't usually, now the non-farmers payroll report is the most complicated. It's got the most other pieces to it. Most of the time, like if we look at the Australian dollar, okay, tomorrow, this first thing in the morning, it's pretty straightforward. And most of the reports are pretty straightforward. That's good. Tomorrow we're expecting, this is today's report. Let's go, I got to take you over live. Tomorrow we are, okay, first thing tomorrow morning, we are expecting Australian retail sales. It's a level 3 report. Okay, that's all that comes out of it. That's it. We have previous at 0.4%. We're expecting a forecast at 0.2%. If we click open and look at this, look at the chart, we can see the first thing that's important for us to see is that retail sales over the last year have been steadily moving upward. Okay, we're expecting it not to fall down. Okay, so a drop down is going to be very negative. The other thing is we can see that when we open up the history report, we can see that this report moves in very small numbers. It doesn't have a wide variance, and it comes in about 1/10 of a point. Okay. So we now know something about this. You could actually take all the 6 months of actual and multiply it together and come up with an average, and then the forecast and multiply that and come up with the actual division there. But it's really a gut feeling. Okay. So what we can say is we're expecting this report at 0.2%. At 0.3 is going to be very market positive. At 0.1 is going to be very market negative. If there's an upward revision in either direction, that's a plus or minus. So basically, if this report comes in at 0.2 with no revisions, it's not tradable. If it comes in at 0.3, it's going to be very positive and send the Australian dollar climbing. If it comes in at 0.3 and a previous revision upward, it's going to still be very strong. If it comes at 0.3 or 0.4 with a prior revision downward, it's going to pull it back in, but not back into being minus to back below the 0.2. Okay. So this will be, if it comes in at 0.3 or higher, it's going to be an easy, straightforward trade for the Australian dollar to go up. If it comes in at 0.2 and has a prior revision downward, it's going to be weak. If it comes at 0.1, it's going to send the Australian dollar straight down. Now, we're usually talking about against the U.S. dollar. The same results will be against cross currency depending on what you're trading and where you want to go. You also have to watch. Tomorrow we have CPI for China, which is going to have an offsetting effect if they have a higher than expected inflation rate against the New Zealand and the Australian dollars. So, guys, I got to go on that note. Sit back tomorrow. Don't make the trade on the non-farm payroll. Build the matrix. Build the thing. Try it out. Use observation, validation, and verification. Build it. Put it together and get a feeling for it. See how it goes. See how the traders respond. Take next week's reports. Put them all together. Build your little fields and get an understanding for this. And then once you've done it for a week, because once you have the understanding of how to build this matrix and how to evaluate, you'll be able to start trading from it in no time flat. But try it first. Don't go risk your money on just, I think I got it right. And I am recording this. It'll be cleaned up and ready on the site in about a week. I think we have another one under the Optionality YouTube channel that you can go see. But try it. It's a great way to trade binary options. Have a great weekend. I will be teaching this class again tomorrow morning also if you want to come back and revisit with us. Have a good night now, and we'll talk to you all again real soon. Have a great trading week. Bye now.